Thanks for tuning into this post-policy conversation with me, Neeraj Shah, on BloombergQuint. MPC has held the repo rate at 4%, the reverse repo at about 3.35, though in something that will be more relevant here on. There is the corridor is 50 basis points as I understand here on, with SDF at 3.75% and MSF at 4.25%. Now, lest this all be confusing to you, let's try and ask our guests to explain if they believe there is a new normal for looking at the RBI policy and what could happen going ahead. Sivakumar, Head of Fixed Income at Axis Mutual Fund, and Kaushik Das, who is, of course, the Chief India Economist at Deutsche Bank, joins us right now on the show. Gentlemen, both of you, thanks for joining in. Hope all is safe. Siva, can I start with you? Can you tell us, in your mind, what's happened and what does this mean for rates?
Yeah, thanks, Neeraj, for having us on. I think it's a very important policy in the sense that it's a final break from it's like a COVID and a post-COVID, and this is the first monetary policy in a post-COVID environment. This is a big pivot from the RBI, officially acknowledging that inflation now takes precedence over growth when it comes to monetary policy decision making. So for the last couple of years, very clearly the focus has been on trying to at least protect growth or protect the GDP levels and try to get the economy back on growth track. And for the first time, talking about the need to normalize policy. And to that extent, all the steps that they took during the pandemic are being unwound. So firstly, the immediate action on the ground is to narrow the policy corridor. The reverse repo spread was 25 basis, had been widened to 65 basis, and now is being narrowed back to 25 basis. Of course, it's no longer the reverse repo rate, as you said. It's the new standby deposit facility. The second is all the excess liquidity that the RBI injected through various measures will now be allowed to run off over the next few years. That's another announcement which has been made. And the last announcement, or rather the last expectation, is for the policy rate to eventually move to a positive real rate. And with inflation forecast at 5.1% for the fourth quarter of FY23, it's a kind of a signal that the repo rate needs to move to 5 or higher. So I think a very, very significant MPC meeting and RBI policy set of decisions today. And I think that's the reason we have seen a significant sell-off in the bond markets, as the markets are kind of moving into this very hawkish or rather unaccommodative RBI going forward.
Yeah, at 7.07 the yields the last time I checked, and very pertinent. So, Kaushik, can you come in with your opening thoughts of what this policy, the statement, and more importantly, the post-statement commentary meant for you? What stood out for you?
I think Shiva has summarized it well, the points that he made. I'll just add a few more points. So the thing is, in February policy, RBI was uber dovish. I mean, if you see the inflation forecast, it was 4.5%. RBI was giving still more importance to growth than inflation, even when oil prices were above 90. So this is kind of a course correction that RBI has made in April, and done the mark to market on inflation, on growth, on the normalization of corridor. So first thing is inflation. They have put more importance than growth after a long time. And indeed, inflation is a concern, and we've been arguing in our reports for the last few weeks that probably going forward, inflation will be a bigger concern for India rather than growth, because we've seen the third wave not kind of impacting India that much. Now everybody's back to office. Even RBI normalized the timing, starting from 9 o'clock, the markets will start from now on. So these are all positive signs, which would mean that growth probably would gain traction as we move forward. Only thing is that the external sector, the oil prices, will have some dampening impact. And that is why RBI has reduced the growth from 7.8 to 7.2%. But the more dramatic shift in forecast is on inflation, 4.5 going up to 5.7. And you don't know if you have more shocks on top of this. RBI has assumed a normal monsoon, but if something goes wrong, you could head towards 6% average as well for FY23. So the concern will be more on inflation. But I think at this point of time, the mark to market that RBI has done on inflation forecast, on growth forecast, those are pretty realistic. And we can work with those estimates. RBI has taken oil at 100 for April, September, which is a very realistic number to work with. Now, the thing is that the reverse repo and the repo corridor should have been narrowed even in the previous policy in our view. So this normalization doesn't come as a big surprise to us, because anyway, the effective reverse repo rate was close to 4%. But RBI needed to give this signal that they're slowly moving towards the normalization path. I think that has come today. And the next stage would be probably to change the stance to neutral from accommodative and then start with the repo rate hike probably sometime from August.
Yeah. Okay. So first, the market impact. Siva, I mean, you outlined it. The bonds have seen a big sell-off. I was just looking at the timelines. We were about 100 basis points lower April last year. We are now at 7% circa. There's a talk of maybe moving to 8% come next April as well. My question to you is, as things stand right now, how swift do you think the movement in yields and rates could be, considering the global picture too? And how swiftly would the Reserve Bank of India thereby have to move now that they've kind of done this change in stance?
It's very, very important not to draw straight lines in these market conditions. So a little over a year ago, we were at about 570, 580 on the 10-year, and now we are a little over 7%. Just to put that number into context, now we are back to where we were in early 2019 in terms of where the 10-year yield is. And back when you're talking about early 2019, which means at the start of the last rate cut cycle. So the market has essentially not just erased the rally which was seen during COVID, but actually has gone back to the almost to the start of the last rate cut cycle. So the market in that sense has already priced in a lot of what RBI is likely to deliver. And if you look at, in some sense, the forwards, calculated forwards, obviously we don't trade like the US and other countries, we don't trade, there's no traded market on RBI forwards, but if you implied forwards essentially suggests that within the next 2 years, we are looking at least 6.5% on the repo rate, if not higher than that. So that's already priced in. And what that means is that unless the RBI surprises either with a significantly faster pace of rate increases or signals that the end of the magnitude, total magnitude of rate increases will be more than 200 basis points. One of these needs to happen for there to be a significant sell-off from here. Otherwise, any pressure, upward pressure on yields is more likely to be transitory in nature because of things like, fiscal deficit. There's going to be relentless supply, 30,000 crores plus per week of GSEC auctions plus SDL. So that is going to keep pressure on rates. But from a monetary policy perspective, I would say that most of the pain is here already. The rise in yields by, let's say, more than 120, 130 basis points from the lows largely reflects the expected change in monetary stance over the coming, let's say, year to 2 years. I'll also add that the curve is not going to behave parallelly at all points of the curve. Is not going to rise by the same amount. So long bonds have already seen a significant amount of sell-off. In fact, today, yields at the shorter end of the curve have risen more than yields at the longer end of the curve, which is normally what happens in a rising interest rate scenario. The curve tends to flatten. It's called bear flattening, where short yields rise more than long yields. And I think that is likely to go on for quite some time, as the curve in India is actually very, very steep. So what that means is that longer end of the curve, let's say beyond 5 years, 10 years and beyond, have already priced in a lot of what RBI is likely to do. Perhaps it's the 1 to 5 year segment which may see more sell-off as compared to the longer end of the curve.
Okay, and we talk about the investment implication at the end of it. Trust me to bring that up, Siva, for sure. But just one quick follow-up. Am I understanding this correctly? You believe that unless something really dramatically changes, the yields as they've moved thus far are kind of pricing in most of the near-term parameters?
Yeah, I mean, if you go back to January, February 2019, before the first rate cut of the last cycle, we were at about 7.25. So, yes, can yields rise by another 10, 20 basis points? For sure it can. But for yields to, let's say, to go to 7.5 or 8, the question is where you started from. That requires a major rethink of where the inflation, for example, will inflation average at 6%? I mean, it's a serious question because for the last 2 years, average CPI has been about 5.7, 5.8. The RBI forecast average CPI for the next year at 5.7. So come this time next year, we could potentially be looking at a scenario where 3-year average inflation is 5.7%. Now, if the market begins to believe that the RBI has changed its thoughts around what the inflation target should be, I mean, just put this into perspective. If inflation for the next 10 years will average at 4%, then 10-year GSEC at 6% makes sense. If we believe that the next 10-year average inflation is going to be 6, then obviously 8% GSEC makes sense. If you believe that the 10-year average inflation will be closer to 5, then 7% makes sense. So today with the 10-year at 7%, it largely what the market is telling you is that on average inflation probably will be closer to 5. So the question is whether RBI reclaims that credibility around that 4% inflation target or not, and how soon they can achieve that. The sooner they achieve it, I think the more the markets will be happy.
Kaushik, your views may differ, but a quick thought here, and just a quick add-on there. If indeed, even for, I think the governor was asked that question, and he said that we'll act if there is a need. But if indeed Q2 inflation print, because of a protracted conflict between Russia and Ukraine or some other factors continues, and if the inflation spills over above 6% yet again in Q2 as well, while the longer term inflation average taken on point is well taken, what about the pressures that the short term yields on the Reserve Bank of India?
So I'll just add a little bit of another perspective beyond what Shiva said. So what he mentioned is that the rate hikes are already priced in. In fact, RBI probably will be delivering lesser rate hikes than what market is pricing in at this point of time. So from that standpoint, yields going up further significantly higher is not kind of expected. If you see repo rate is at 4%, your 10-year bond yields are above 7%, so 300 basis point spread. This is almost, and it can go up a little bit more, as Shiva said. But the bigger problem is the demand-supply mismatch, because you'll have supply of bonds hitting you every week. Last year, if you remember, April to September, RBI had bought 2.1 trillion, worth of bonds through their GSAP program. This time, who will be buying those incremental bonds? That is the problem. That is why the yields can still go up if the RBI doesn't buy enough bonds. Not because we are expecting, rate hikes to go beyond 6.5%, 7%, which is already priced in. It's more about what kind of demand for bonds buying, come in, and who's going to buy those bonds. Are banks going to be, kind of take up the entire bonds of 8.5 trillion gross number that is there for April, September, or RBI has to come in and buy some amount of bonds? So today, if you see, RBI has not said anything specific about GSAP or OMO purchases. They've just said that we'll support the bond market through different instruments. So I would expect as yields go higher, there will be kind of support from RBI through open market purchases of bonds, through Operation Twist, so that they don't add additional liquidity, but they support or anchor the longer term bond yields beyond a certain point. Probably RBI will not want 10-year bond yields to continue rising at a particular level, which can, dampen growth expectations. So that angle of RBI support and where they want bond yields to settle is important, not just from a rate hike point of view, just from the demand supply point of view. The second part is where can policy rate go up to? Now, as Shiva was saying, that inflation average is, RBI has given 5.7. Last year, FY22 is supposed to end with 5.5% inflation. This year, we are talking about 5.7. This year, as in FY23. And our FY24 forecast also suggests that inflation will be around 5.5%. So even if you assume that 5.5% average is what the inflation would be post-pandemic, the repo rate has to go up to at least 5.5% so that you have non-negative real interest rate. I'm not saying real interest rate will go up back to 1.5%, 2% positive, which used to happen in the older RBI regime. But even if you want zero real interest rate, not to create macro instability for a future period of time, the repo rate has to go up to 5.5%. So I would assume 50 basis points repo rate hike in calendar year 2022. So probably one repo rate hike in August and another one in December. I don't see RBI going too aggressive on repo rate hikes or going back-to-back repo rate hikes. Even if inflation is higher than 6% for a few months, I think RBI will go slow on the repo rate hike because the rates have already risen. RBI just has to catch up. So I would assume 50 basis points in 2022 and another 75 basis points in 2023 when the growth has improved further. Then slowly RBI is going to move the repo rate from, so if this end of the year it is 4.5, by the end of next year it could be at 5.25. That will be close to the inflation average and real rates will be close to zero. That is the framework which I have in mind while kind of calculating the terminal repo rate.
Interesting. Well, I think my conversations with corporate India seem to suggest they'll be very happy with this. Kaushik, just one quick follow-up on the sticky part of the inflation. But whichever company I talk to, and the listed ones are obviously the larger ones, they talk about gaining market share from the unorganized and the smaller ones, right? and the point that brings out then, because they have the pricing power, they are pricing their goods to perfection. There's no supply from the unorganized, or the very less supply from the unorganized or the smaller players as well. So the pricing power leading to higher prices, leading to sticky inflation, could that be a worry in the near term? Could it be sticky in the near term?
Neeraj, I think that is already a worry. And if you open any newspaper anywhere, if you travel within India, we are seeing inflation, kind of becoming generalized, becoming persistent. And as India opens up more and more, a lot of people would be traveling within India as COVID has come down. We are all going back to office. So inflation will be a kind of persistent threat going forward. On top of that, you have the problem of food and fuel inflation, right? I mean, if you have a abnormal monsoon and those kind of supply shocks are there, that risk is there. But from a core inflation point of view, companies passing on the price increases to end products, I think that problem would be there. It has already started, whether you see FMCG products or if you see any other finished good products, that will keep on increasing over the next few quarters. So this 5.7% forecast that RBI has given is quite realistic, and it's very close to the 6% upper threshold mark. We should remember that. So after the pandemic, probably India's inflation has kind of gone up, and we have to accept the fact that going down to 4% would be a problem. And therefore, the inflation expectations of households, which used to be 9% on an average before the pandemic, when inflation used to average 4%, that has gone up to 10.5%, 11%. So I would assume the inflation expectations to be also higher. Therefore, RBI needs to kind of at least do something on reducing the expectations or the second order impact of inflation, which I think already has become a problem, and going forward, it will become a bigger problem than growth in my view.
Okay, gentlemen, I won't take too long. The final questions from both of you. For this, Kaushik, I'll come to you. I mean, I didn't want to just make it a rate and an inflation conversation. What else stood out for you? You laid out some other 7 points as well. And there was a lot of talk around those as well. What else aside of this stood out for you in the policy statement or the press conference later?
So one thing which RBI has done, you must have noticed that they've increased the HTM limit from 22 to 23%, and they've extended it by 1 more year. So that will motivate banks to buy more bonds and hold it so that incremental demand gets created. The problem that I was talking to about demand supply mismatch, so that banks buy. So we were expecting that. So it's not a surprise. It has come through. So that's something. The second thing, which is a bit confusing, and this was asked during the press policy conference, is that in one paragraph, RBI has mentioned that they will be reducing the liquidity surplus over a multi-year period to bring it to levels which are consistent with the monetary policy stance. Now, the problem is, if I am assuming monetary policy stance to become neutral by, say, June, then will the liquidity also come towards neutrality by June? That means, absorbing the surplus liquidity to a great extent. On the other hand, if you think like, liquidity will be brought down, the surplus will be brought down over a multi-year period, then when does the monetary policy stance neutrality come in? Is it a later period? So that's a little confusing. I think RBI means the direction of the journey, whereby they want to bring the liquidity surplus slowly down, and from the next policy, the monetary policy stance also becomes neutral. That's a kind of guidance that RBI has given, which helps the market to prepare for expectations of rate hikes in the next few quarters.
Okay. Siva, what stood out for you, and any thoughts on the point that Kaushik raised, of course, and wrap it up, Siva, with what should a debt investor do? Because everybody is asking about whether we should completely be away from the shorter end, or now there is no need because you believe that chalo bahut ho gaya.
Yeah, no, I think a couple of things stood out for me, and one glaring omission. What stood out for me, of course, I mean, I think Kaushik has answered it. I don't want to go too much into it, but I think the introduction of this new tool, SDF, to absorb liquidity, and of course, they can use SDF to absorb more durable liquidity if they need to, because while they have opened it up today for one-day liquidity, if they need to absorb liquidity on a more durable basis, there's nothing stopping them from acting. But I think that's premature. I think let them do it in a slow manner. It appears that they're comfortable in allowing this liquidity to come down over years rather than over quarters. So in that sense, RBI doesn't seem to want to be very disruptive when it comes to liquidity. So raise the price of money, but not reduce the quantity of money. That seems to be their thought process. So when it comes to what they missed, and at least from a mutual fund and investment perspective, there was a lot of expectation that they would do something about this, at least from a mutual funds, overseas investment limits being relooked at. That is an RBI's quote, and has been sitting there for a while. I think a big disappointment that they didn't choose to address that as part of their regulatory policy updates. So I think that's something which I think investors would have been definitely looking forward to from the RBI this time. Now, when it comes to investing in debt, like I said, most of the pain or expected rate hikes are now in the price. I agree with Kaushik that if inflation averages no more than, let's say, 5.5%, then we should expect the repo rate to maybe go to the 5.5% band. Markets are pricing in 6.5 or even higher. So there's an opportunity right now, I think, across the yield curve. There are pockets of the yield curve which well, I will not say to just go long duration, but I think there are pockets of value emerging across the yield curve as a result of this big sell-off. So I think there will be an opportunity for investors, especially at the longer end of the yield curve. At the short end of the curve, I think, is where there's likely to be more pressure. Like I said earlier, it's the short end, the 2 year, 3 year, where we have seen the most sell-off today, and I think that is likely to continue. So investors should look at what's classically called a barbell strategy, where you're buying money market or floating rate bonds on the one hand, and buying some long duration bonds, and avoid that sort of middle part of the curve. I would say that'll be a good way to manage your portfolio at this point of time. Floaters, I think, will be hugely valuable in this environment. Given that there's a lot of GSEC and corporate bond floaters available these days, I think floating rate bonds will become very, very interesting for investors again in this environment. So I think there are multiple places. And the last point I'll make here is that 2 years during the pandemic, one big challenge we had as fixed income investors was how to beat inflation. Average inflation was close to 6%, and the entire yield curve was below 6. So how would you, with reasonably good quality, we're talking about G6, AAA, etc. But now, with inflation perhaps going to be below 6%, every part of the yield curve beyond the 2 year, 3 year segment is above 6%. So even to start building a portfolio now which can actually beat inflation on a sustained basis is well possible, at this point of time. And I think real yielding assets will hold value even in a rate hike cycle. So if you buy assets which are significantly positive real yields, AA bonds at 6.5%, 5 to 10 year G6 and AAA assets, which are today now giving you even the ability to go well above 7 in the case of G6 and AAA bonds, let's say the 10 year space. All of that will hold value even in a rising interest rate environment. So I think there's a lot of pockets where I see significant value for investors to hide even in a rising interest rate environment.
Okay. Gentlemen, both of you, thank you so much for taking the time out and giving us a lowdown of what you made of the policy and the implications thereof. Much appreciated.
Thank you, Neeraj.
The pleasure was ours. Viewers, thanks for tuning in.